Good afternoon, everyone. Today is January 27th, 2023. Shout out to my friend Phil. Happy birthday, Phil. No slides today, so you get to look at my smiling face. I apologize for that in advance. But today, after the disclosures and the roundup, we're going to talk about stocks and bonds and mutual funds. What's the difference? I am Stephen Herwire, and I am the owner of Herwire Financial Plans with Direction. First, a few important disclosures. Opinions voiced in this material are for general information only and not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is not a guarantee of future results. All indices are unmanaged and may not be invested in directly. All data is believed to be from reliable sources. However, no representation is made as to its completeness or accuracy. None of this is to be construed as tax or legal advice. Consult your advisor prior to taking any action. Last night's numbers. Dow Jones Industrial Average closed at 33,949.41. Year to date, it is up 2.19%. S&P 500 closed at 4,060.43. Year to date, up 5.75%. The NASDAQ 100 closed at 12,050.6. Year to date, it is up 11.38%. Gold closed at $1,940 per ounce. Year to date, it is up 6.41%. The Bitcoin index closed at 23,080.56. Year to date, it is up 39.37%. US dollar index closed at 101.81. Year to date, it is actually down 1.62%. 10-year Treasury closed at 3.5%. Year to date, it is down 0.38% from its start at 3.88%. And finally, the S&P Aggregate Bond Index closed at 200.72. Year to date, it is up 2.86%. Stocks, what are they? They are ownership in a company. When a company does well, the owners, generally speaking, do well. And when it does poorly, generally speaking, the owners do poorly. And I'm going to give you a real life example. This is way oversimplified and leaves out a lot of detail, just trying to paint a basic picture. Bob and Greg decide to go into the pizza business. They both pitch in $50,000 to set up shop. So let's suppose they're doing a brisk business. And at the end of the month, after all the bills are paid, they split the profits if there are any. And since they both pitched in $50,000, the profits will be split right down the middle. In this hypothetical example, Bob and Greg are stockholders. So let's assume they're making money hand over fist. And they decide, yeah, what we need is a second location. But they don't have $100,000 lying around. So they approach their friend Rich and they say, hey, we'd like to open up a second location. Here's our business model. We'll make you a 50% owner. You just pitch in the 100 grand and we'll be 25% owners. Rich looks at him and says, no, I don't want to own a pizzeria. And they're sad. And then he says, but, and stay tuned if we're going to do a break in between that. We're going to talk about bonds and you'll see where this is going here in a minute. What are they? They are money lent to a company or a government, or those are the two main issuers of bonds. When the company does well, the bondholders, generally speaking, get paid. And when the company is doing poorly, the bondholders get paid before the owners get paid. So in this example, back when last we left our heroes, Rich has just lent Bob and Greg $100,000 to set up that second location. Now, the terms of this loan are he gives them $100,000 and they agree to pay him 6% interest for the next 10 years. Okay, and he wants monthly payments, so 6% of 100,000 is $6,000, so he gets $500 a month. And he keeps getting that until the 10 years is up, in which case, you know, Greg and Bob got to cut him a check for 100,000 to pay him back. So Rich gets a steady interest payment. If the shops do well, Rich has a greater assurance of getting paid what he's due. In this hypothetical example, Rich is the bondholder. Greg and Bob, they are stockholders. So what happens if things go well? Greg and Bob make lots of money. There's a good chance they'll expand, but there's also the chance one or both of them will sell their interest in the business for a profit. Rich will likely get his interest payments and his principal return. Now just remember, it's the easy way to remember it. Stocks are ownership and bonds are loanership. So what happens if things go badly? Okay, suppose somebody makes the decision that mozzarella is bad for you and they outlaw it. A little bit extreme, but just to illustrate a point. And we all know how good pizza is without mozzarella cheese. So there's a good chance Bob and Greg will stop making money and they could go bankrupt. Okay, Rich may be at the risk of not getting his interest payments and not getting his money back. So if this happens, Greg and Bob sell everything off in the bankruptcy proceeding and they've got a pile of cash to divide between themselves, and then Rich shows up and says, hey, you owe me. So being that he's a bondholder, he has priority over them as far as those funds go. If there's anything left after they've paid Rich and all their other debtors, then they get to split what's left. So if things go badly, bondholders generally take priority over stockholders. So all this sounds nice, interesting, but it sounds really risky and only for the very rich. I mean, there's lots of folks that don't have $50,000 lying around. How does somebody in that position invest? Well, one way is using mutual funds. Mutual funds are a way for people who have less to invest, and they also have the possibility that they could diversify to mitigate some of the risk, because in our aforementioned example, both are, you know, Rich, Bob, and Greg are all taking a massive risk on one business. And what a mutual fund can do is it can spread it out to multiple businesses. So I'm going to construct an imaginary mutual fund, the Pizza Slices mutual fund. Now, as far as I can tell, there isn't actually a fund that invests in pizza companies. So don't go look at, well, I mean, you can look for it, but you probably won't find it. Okay, so, but this mythical Pizza Slices mutual fund, the fund hires a manager. We'll call him John Doe, who knows all things pizza. He can't toss a pie or put on toppings. He can barely do microwave pizza, but he knows everything about the ins and outs of all these different companies, be it Domino's, Shakey's, Little Caesars, Pizza Hut, you name it. And so Darren and 1,000 of his friends, they all have $1,000 they want to invest, and they invest into Pizza Slices. So this is $1,001,000. John starts buying and selling shares of pizza companies. Now, he's going to get some winners and he's going to get some losers, but because of his expertise in all things pizza companies, there's a good chance that he will have more winners than losers. Now, this is not always the case, but he's going to evaluate the market. He's going to evaluate the companies and figure out the best time to buy, or what he thinks is the best time to buy each and every company. So mutual funds, they come in all varieties. They can invest in stocks, bonds, and all sorts of other things. Everyone comes with a prospectus that describes where they will invest, the expenses, and various other pertinent information. These prospectuses will also describe the rules where the manager can invest, like with the mythical Pizza Slices mutual fund, he can't go out and buy McDonald's necessarily. but he might be able to. It just depends on what it says. That's why it's really important to read the prospectus over carefully before you buy. And if it's confusing, you can consult me or somebody like me to help you understand. They can be, mutual funds can be purchased in brokerage accounts or directly with the company. And I can help either way. Millions of people use mutual funds in their retirement accounts. It may be an excellent vehicle for long-term goals. Don't go putting the down payment for the house you're going to buy in a year or two in it. I think that's almost always a mistake. But if you combine regular saving into mutual funds in conjunction with a good financial plan, it can improve the odds of your achieving your long-term goals. In my opinion, a good financial plan is essential for achieving your long-term goals, like retirement. Now, there's no guarantees, but this will improve your odds of retiring in a manner and time of your choosing, and I can help. My website, herweyerfinancial.com. Since we don't have slides, I'll spell it out for you. HerweyerFinancial.com. In the upper right-hand corner of the website, every single page has a schedule an appointment button. I do in person, I do Zoom, I do phone appointments. And 2 buttons over from that to the left is a red YouTube button. If you want to see more videos like this, please like and subscribe. If you and your friends want more information, you can follow me on Facebook, LinkedIn, or Twitter. Thank you for listening to me. Oh, by the way, those who want to pick up the phone and call me, 518-631-2569, 518-631-2569. Thank you and have a terrific weekend.